I mean, if you like silver, imagine thinking of, buying silver in the ground where you get, even 10x of performance over a silver move of, $5 an ounce.
Yeah.
So, for me, this is really where the game is. And the accumulation process, I really mean that, because what you said about in 2-3 years from now, if I want to go back to this clip 3 years from now, I really hope that I've accumulated as much as I can of properties that have silver in the ground today.
Yeah.
Because I think that's the best trade out there.
Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Tavi Costa, Portfolio Manager at Crescat Capital. Tavi, great to see you.
Hey, guys. Thanks for having me again.
Awesome. So, Tavi, when the helicopter money stops coming, what happens to the economy? How will that affect the actual stock market?
Wow, it started strong.
Big question. Big question.
Big question. Look, I've been looking at the euro dollar curve quite a lot in order to have a view about what the market thinks when it comes to what the Federal Reserve is going to do here. It seems pretty obvious that the steepness of that curve was pricing in that the Federal Reserve could potentially start tapering. The real question is how sustainable that is. And I think that when you look at treasuries selling off the way they are, with absolutely zero pressure from the supply side of this equation, and knowing that the Federal Reserve still is buying $80 billion of treasuries and 40 of mortgage-backed securities, but talking about treasuries, it's insane to me that we're seeing this level of sell-off. By the way, we're not too far from the levels we reached back in March of this year when we were all talking about what yield curve control. So how long is it going to take for us to go from tapering to yield curve control as a narrative? I don't think it's going to take too long. I think, another 3-4 days of a move like today, I think we can see that very quickly. There's a lot of ramifications from that of the Federal Reserve allowing 10-year yields to rise. And let's say they do want to allow it to move further, perhaps even in a 2 territory or even above that. What does it mean to the equity markets? And what does it mean to tech stocks that today are getting hammered? There's a lot of answers, in my view, to that. And I think it has to do with how the Federal Reserve truly is trapped. We're seeing a deceleration of growth of the economy. The Federal Reserve should have done what they're doing right now 6 months ago, 7 months ago. They had a window to do it.
What is that window? What should they have done 6 months ago specifically?
So let's just say, Jim, you're trapped and you have to figure out a way of get out of this situation. You would take any possibility, any opportunity you would take it to get out of that position. There's no doubt that the Federal Reserve is trapped. I mean, you look at the federal debt relative to GDP today. If we have any inflation to the levels that we saw in the 70s, which I think we are seeing right now, how does the Fed even fight that issue? Meaning, shock the world, raise rates by 2%. It can't even do that, as I said before. So it truly is trapped. Don't get me wrong. But they would at least try to get out of the situation by trying to avoid or perhaps remove some of the liquidity that they have been putting in the markets, maybe doing a little bit less of QE, tapering. And unfortunately, I don't think they've done that. They didn't take that approach back then. Why? Because they're looking at lagging indicators. They're looking at the labor markets at the time, rather than looking at a lot of the leading indicators, such as the commodity prices, and all the other prices we're seeing surging at the very beginning of the year. Not that they're not rising right now, but certainly they were surging back then. And, it was pretty clear there was an inflationary shock coming here.
I want to share and go back to something here, because you were saying, how do we get out of this trap? Yep. And just today, one of the Fed governors, Bullard, said, he's calling for balance sheet to begin declining as soon as the bond purchases end and 2 rate increases in 2022. And that's just, and my comment was, this is just total, this ain't going to happen. They're going to reverse policy as soon as they get the market tanking. That's the definition of being trapped here. So why are they even bothering to say stupid stuff like this when they know it can't happen?
I can't answer that question specifically because I don't know what's going on there. But what I can say is I mean, there is no way around this. I mean, you do the math on anything from treasury issuances, from the fiscal agenda and all the fronts that we have, from peak inequality issues where the Federal Reserve and which has been causing a lot of the inequality issues, with the government really trying to work on that. You have China, geopolitical issues with China that is forcing the government to continue to spend even more money to prop up domestic companies to compete with China, which is an approach that China has taken for so many years. You got the Green Revolution happening. At the same time, you got an infrastructure revamp idea. Everything, it points to the direction that we're going to see double-digit twin deficits relative to GDP for longer than most people think. But I do think ultimately for any investor, it's tough because you got those daily moves that sometimes changes your view in the short term, medium term. But it seems pretty clear that inflation expectation is going to continue to run hotter than cost of capital as a whole, meaning we're going to see negative interest rates for longer. And I think that just creates this whole idea of why you guys are being so successful running into this idea of silver, gold, precious metals, miners.
Not lately. Why isn't gold and silver working right now? Why?
Yeah. We were offline talking about this. I'm definitely perplexed about this question because I don't think, including myself, no one has done a great job answering that question. I'm working on it too. So my answer right now is not going to be to the level that I think. But the fact that the Federal Reserve is strapped is what really puts gold in a scenario where I think investors should be accumulating in their position rather than doing the opposite. The other answers, possible answers to this, I think has to do with tapering. I think that the yield curve, the euro dollar curve that very few people are paying attention to, which prices the likelihood of rise in interest rates in the future. You can see that when that curve starts to steepen and the markets begin to really bet on higher rates, short-term rates over a long period of time, what you start seeing is that clearly the Federal Reserve or the market is pricing in the Federal Reserve is going to have a tighter policy than they have had in the past. And if you believe that is going to continue, obviously you should be short gold. I don't believe in that. I really don't think that that's even possible. I think there's two forces that are really big here. One is the debt problem. And it's obvious that the debt problem is a big issue, but it's not so much on the household side, actually. Households have been deleveraging, believe it or not. It's really in the government and corporate side that is streaming as a problem. The other issue is on multiples of risky assets, from the stock market, from corporate bonds, from even housing markets, depending on the region. It's quite insane the realm of assets that are today near record levels at the same time as we barely had any interest rates rises right now and already impacting risky assets. So you would think that that is one of the sole reason why we're seeing those issues.
So Tavi, with the deceleration of the growth in the actual economy, are you seeing stagflation anytime soon?
Well, I think that takes some time to develop itself, and certainly I do. The answer is I don't think you see stagflation for long periods of times, but I think you may see one here in the next 6 months or so. Everything is pointing towards that direction, where, especially coming from Asia, deceleration of growth in Asia and actual downturn in Asia is I think it's going to become contagious, and it's already becoming contagious in the U.S. And so you see the correlation between Asian markets and the macro data in the US and other parts of developed markets. I think that we'll see a deceleration of that, and inflation will remain pretty sticky in terms of being historically elevated.
Well, one of the other, you just spoke about Asia. I'm going to share one of your charts that you recently, Asian versus global stocks. These are diverging. Tell us why this is important. Why are you keyed in on this one?
It's a good question because China's been responsible for about 60% of global growth in GDP terms since the global financial crisis. And there has been this idea that the CCP cracked down in domestic companies and the ADR issues in the US, where a lot of ADR stocks have declined significantly recently. A lot of people thinking that those are independent issues and they're not contagious quite at all. I completely disagree. Obviously, we saw China Evergrande being the second example of this. Those are all symptoms of a much, much bigger debt problem in China, where I think a lot of actually gold lovers or gold bugs are getting this wrong in regards to what's happening with China. It is a true credit bubble that has this exogenous risk to the market in the US, in my opinion, where the Fed has zero control over what happens in there. And so I think that it's quite important to see the real estate market in China is starting to crumble, along with all the issues. I mean, just look at PMI numbers of China. No manufacturing PMI numbers are at lower levels than they were at the depth of the global financial crisis already. And so, not a lot of people talking about this, but it's already contagious domestically, meaning in China. So I think it's a matter of time for us to see this starting to face issues here in the US as well. So I'm very focused on what's happening in China.
Well, this leads to another graph that you posted recently, is China industrial production of crude steel, which seems to be, dropping precipitously in 2021. Is that sort of an early indicator that, a ton of this steel is used in the property market, in the building market in China, and you're seeing the Evergrande thing implode. And that's 20% of their economy is the property development market. At least that's a number I saw recently. Is this sort of a key signal of a Chinese slowdown?
I would say so. And I think that, iron ore has been pointing to that direction for a while. This is the first time we're seeing a large economy with the relevance of China that is really having to decide between inflationary issues that already are in the system of the Chinese economy. And you look at CPI numbers from the Chinese government showing about 0.8% year over year growth, which is absurd because when you look at import prices from the US, you see somewhere close to 9% year over year, which it tells you if the US is importing most of their goods and services from China, there has to be that gap seems to be completely absurd in my view. So there's certainly inflationary forces in China today. But at the same time, we're seeing China really hit a wall of debt. And the question is for central banks like the PBOC is, what route are they going to take? Are they going to take the inflationary route, meaning adding more liquidity to fix the issue, but adding to this inflationary problem? Or will they let things resolve themselves and create a reckoning moment at a 314% banking assets to GDP problem, and clearly a credit bubble, allowing them to implode? I really think that central banks in general tend to always go back to the liquidity side. And so I think that that's going to lead to probably a devaluation of the yuan. I think that is not priced in and implied volatility of the currency relative to the dollar, but also mostly relative to tangible assets such as gold and silver and so forth.
Well, I'm going to turn to your recent newsletter and a chart that really, lots of people are talking about this in the United States is, I think the car inventories on, and this leads into the chip shortage that is driving, crazy numbers in used car prices and new car inventories. This is a chart you included on your recent newsletter. Tell us what you see here.
Well, what is surprising about this chart is that if you look back in 2019, this was already at all-time lows. No one was talking about this, but this was already at all-time lows, car inventories, regardless of what happened with the pandemic. So really, we were already going towards that direction. Now, the situation obviously was exacerbated or magnified by the issues with the pandemic. I think that the supply issues are becoming geopolitical issues, number one. But number two, it goes back to why we're invested in natural resources. It's astonishing to me how so many analysts and people on Wall Street have absolutely zero idea what it takes to develop a mine and develop those raw materials that are used to build goods in general across the globe. And so I think that's the lack of labor in geologists. Is hard to find good high quality geologists in anywhere in the world today. You can't find infrastructure to build, to drill. You can't find infrastructure to actually explore a land or develop a mine. And you have the ESG concerns and geopolitical issues with the green agenda. What else do we need in order to suppress this issue with supply problems right here? And so I think this is we're moving towards that direction before the pandemic, but the pandemic just created that tendency to almost like 5x, and so in a very short period of time, and people thinking we're going to get out of this very quickly. I think everyone is starting to realize that this is a much bigger problem. And now you're adding just another issue, which is the geopolitical situation of China and US. I really think that this is a part of the structural change of inflation in the system. And so I think this chart is very important.
Well, another chart that you had is the natural gas chart. And, we're hearing, electricity prices are just going vertical in a lot of European countries. Because of this, there's shortages everywhere, supply problems. What are you seeing natural gas? This looks like a breakout.
Yeah, it looks like a breakout. It's natural gas is also known as the new lumber. Yeah. It's up about 3 times what it was a year ago. It's having its best year-to-date performance in the last 30 years, I believe, or 20 years. And so I think what it means is the main reason why we didn't see inflation coming out of 2008 in a large way. There's a lot of reasons behind it, but we didn't see a sustainable growth of commodity prices. We saw it initially all the way to 2011. But most commodities enter a bear market after that, all the way to now. And so I think that has been the main reason why we haven't seen inflation in the system really grow more sustainably. We have that changing now. Investors, for whatever reason it is that because inflation expectation is higher than most investment alternatives, and investors are beginning to buy tangible assets. I think usually that's one of the main reasons is the lack of capital allocation towards commodities in general. You look at pension funds and so forth. No one is investing in commodities today anywhere close to where they used to invest back in the 70s. And so I think there's a lot of reasons why that capital flow is beginning to impact prices. And then you have the supply issues at the same time, and all this, political and geopolitical problems happening, which also are intensifying this move in a large way. So I think commodities are at the beginning of a secular move to the upside, not the end of one. It's incredible to see the strength of commodities, regardless of what's happening in China, by the way, aside from iron ore, really. So I think this move is real.
Well, on to our favorite chart here at Wall Street Silver. Tell us what's going on in the silver market. This is the one that hurts. This is the one we're crying about, Tavi. Give us the good word. What's going on?
Look, guys, I don't have kids just yet, but I cannot wait to tell my kids that I was able to accumulate silver before going higher than $30 an ounce. I mean, what world are we living in where every macro direction and driver that you would expect that is pro for silver is here, and we're seeing the silver struggling to go above $25 an ounce. I mean, there's some people calling for silver to be in the teens, and I think it's absurd. I think that's just it's part of the sentiment that we're seeing It's fine. Things are fine with the silver market. We're just seeing, just like gold, we saw a big move. And now we're just seeing a consolidation period here. And I think, from the supply side, nothing has changed. If anything, it's only gotten worse. And so we're struggling to find, primary silver deposits has always been a problem, but even secondary deposits of silver has been difficult to find. And so the supply side, it remains very compelling, the story there. On the other side of demand, it seems clear to me that silver is right in between this green revolution, the monetary asset situation, the monetary disorder, fiscal disorder, type of asset that should benefit from this. So I'm a big fan of silver. I don't know when it's going to take off, but I really think we're going to see an explosive move to the upside, as I've said before. And I view this as a great time to accumulate. Why not?
Yeah, I mean, if they're gonna be so stupid as to keep giving it away at $23-24 an ounce, say thank you very much, and back up the truck. And people are whining about this right now. It's a lot. You see it a lot on Twitter. You see it a lot on Reddit. Whether it's, hey, why is it? We're over this difference between 25, 23, 22. And I honestly think, it's just my gut opinion, we're going to look back at this 2 or 3 years from now, and I'm going to interview you again.
Yeah.
And I'm going to run this clip from today, and we're going to be laughing when it's 120 or something stupid, some stupid number higher. And we're going to say, can you believe back in September of 2021, we were whining about 22, 23, why it's, can you
gotta back up the truck?
I honestly think we're just going to be laughing about this 2 or 3 years from now.
It's interesting. The following base of silver is very similar, and you guys are a huge example of that, of people on social media really that buy into this thesis of silver. Is so large, and it reminds me of the crypto community in a large way, much more than gold, I think. And perhaps because of the probability or likelihood of high performance type of asset. I mean, if you like silver, imagine thinking of, buying silver in the ground, where you get, even 10x of performance over a silver move of, $5 an ounce. So, for me, this is really where the game is. And the accumulation process, I really mean that, because what you said about in 2-3 years from now, if I want to go back to this clip 3 years from now, I really hope that I've accumulated as much as I can of properties that have silver in the ground today.
Yeah.
Because I think that's the best trade out there.
Yeah, I'm heavily into the miners. I'd say I'm 85% in the mining stocks and about 15% physical right now. I keep it a little balanced, but the physicals, that time thing, you don't touch it ever. I don't care what the price is. And then if the price gets up high enough, I'll trade my stocks, my mining stocks, but the physicals just put away forever. Give it to my kids or something. That's just my strategy anyways. But Ivan, final question.
Yeah, Tavi. So Senator Elizabeth Warren said to Powell's face today, you're a dangerous man and I will oppose your renomination. And they actually turned the camera on Powell, and you could just tell in his head, he's saying, thank God. He's like, I'm sick of this shit. Do you think Powell should be reappointed?
Oh man, that's a tough question, because I don't, not only I don't usually share my political views, but not that this is political, but in this one, I'm going to try to answer. Look, I think Jay Powell was doing a great job at the beginning. It seemed like he was trying to really be this more hawkish Fed member, and then it turned into probably the most dovish person I've ever seen in my life. And maybe he knows something we don't know. I have no idea what the motivations are behind this. Well, clearly has been trading his own account and taking advantage of this move. I think this is absurd. Those news about what we saw with Kaplan and other folks that
Rosengren.
This is absurd. This should be those guys should be all arrested. I mean, I go through a ton of compliance issues to buy a miner, and I have zero control of the monetary system, and I can be arrested if I do anything stupid that is outside of the boundaries of our compliance rules in the company of Crescat. And so, how in the world those guys are still operating the way they are? Sure, two of them resigned, but let's be honest, this guy should be in jail right now. So I'm happy to take that question.
Well, you know something. Here's the thing. You know, as much as we joke about Jerome Powell and everything that's happened the past couple of years, I almost am more afraid of who they would replace him with. I mean, I think they would come up with some, what's his name, Stephanie Kelton, or some monetary theory, the magic money theory, MMT type of personality that just takes what's been going on and just to a factor of 10 beyond what we're doing right now. Just literally free helicopter money, direct deposit. I just don't even know what they could dream up, but I think it would be 5 to 10 times worse than what we've seen already.
Oh, I think it's possible, and I think it's kind of inevitable.
Inevitable, yeah. They're trapped. They can't quit.
Yep.
All this bullshit with raising rates or tapering. I think as soon as they have a 10% hiccup in the market, boom, it's all off the table, and they're back to 120. But they're probably taking up to 200 billion a month. They're beyond in buying bonds and whatever. But hey, Tavi, it has been great to see you again. Thank you very much for your time. We'll do it again in 2 or 3 months as the market develops. The community appreciates everything you do. Thank you, sir.
Hey, thanks for having me. And I'm a big fan of you guys, and I'm cheering you guys on. So hopefully we'll see you in that clip of 2 years from now. I hope that goes.
I hope we can laugh about this in 2 years, about $22, $23 an ounce. All right.